viewers, welcome to Simple Accounting channel. This is Uttam Sir. I am going to discuss break-even point analysis today. What is break-even point analysis? Break-even point analysis is the management topics for decision making. What actually the break-even points? Break-even point is the level of sales or level of output which makes the company the zero contribution. It means nothing to get by the entrepreneur. So what actually that mean? It means maybe you have the total sales or revenue is $15 million and you have also the cost of $15 million. So $15 million minus $15 million, that is the zero contribution. This is the break-even point. This is very important tools as because it provides some of the vital information to the business which is very much helpful in future. Break-even point analysis can be discussed in two ways. Break-even point maybe by formulas, maybe some of the graphical representation. Break-even points may be more or less, we have the 6 formulas to calculate the break-even point. I am going to discuss that later on, but what is the benefits of break-even points I am going to discuss right now. First benefit of break-even point, it is very easy to understand. Every shareholders can easily understand what actually the break-even points. Second point, we can find through the break-even point analysis what the amount of sales we have to make so that the company can get the break-even point. Again, what the amount of units going to be produced, that also be find through the break-even points. Maybe you are interested to produce 500,000 units. So 500,000 units can be calculated through the break-even point. And another benefit is that this break-even point can be helpful to compare with the other business. And another benefit of break-even point analysis, we can take the business plan or some of the initiatives so that the break-even point can be achieved. So it is the management. The management, those are the managers, they can find some of the ways and means so that the break-even point analysis can be achieved, or break-even point, the figure of break-even point can be achieved. Now, what is the demerits of break-even points? There is a lot of demerits over here. The break-even points basically some assumption. So what the assumption you are just making, that may or may not be available in the practical situation. Maybe the first assumption is that the total amount of sales, that is to be gauged out, that is to be assumed. But practical environment, the sales is to be vibrant, flexible, but it is continuously considered that it is to be the fixed amount. What is the fixed cost? Here the fixed cost is the cost which to be remain unchanged for a particular year. But reaching some of the certain level, the fixed cost may be changed. So but this is not considered. Maybe the cost and the revenue linear where it is to be changed. But in practical field, that is not possible. Another problem of break-even point is that the situation in the market, maybe it is the qualitative factors that cannot be considered. Maybe the rivals product quality, rivals product strategy. So this is not to be considered by the break-even point. So whenever the company is going to depend on the break-even point analysis, then they have to take into consider these factors which may get problem in future. So right now I have to discuss the different formulas through which we can get the break-even point. Here you are requested to see the board over here. First of all, number 1, break-even point in unit. First of all, we are going to calculate the break-even point in units. The formula is that fixed cost divided by contribution margin per unit. Contribution margin or contribution to sales. CM for contribution margin oblique CS contribution to sales. You can write this the same thing. So CM per unit. So how that is to be calculated? First of all, from the practical information, some of the question paper, you have to get the fixed cost, as well as you have to get the variable cost. You have to get the selling price per unit, or total sales volume is given, and variable cost. Sometimes you are not given the variable cost, maybe the total cost is given, so that is to be divided by unit, then you got the variable cost per unit, that also be given. If it is not given, you have to calculate it. So the formula is that fixed cost divided by contribution margin per unit. How you can calculate the contribution margin per unit? Here you see the asterisk mark is over there. CM per unit. It means selling price per unit minus variable cost per unit. Selling price per unit minus variable cost per unit is the contribution per unit. So fixed cost divided by contribution margin per unit. Then you got the information of the break-even sales in unit. How much unit you going to be produced to make the break-even. So this is the formula of getting the break-even point in units. Right now, break-even points in volume. Volume means total amount of sales. Total amount of sales, maybe the dollars or pound, or the taka or rupees, whatever it is. So break-even points in units, the formula is that fixed cost divided by contribution margin ratio, CS ratio or CM ratio. Contribution margin ratio, how that is to be calculated? Here the asterisk mark is over here. CM ratio. CM ratio means selling price per unit minus variable cost per unit divided by selling price per unit. Selling price per unit minus variable cost per unit divided by selling price per unit. Then you got the contribution margin ratio. So the fixed cost divided by contribution margin ratio. Then you got the figure. The figure is to be said the volume. Volume means the it is to be the dollars or it is the rupees or the pound, like this. This is the volume. The break-even points in volume. Right now, number 3, break-even points. Break-even points, desired profit in units. Maybe the company is interested to make a specific amount of dollar for the profit. This is the desired profit. Desired profit in units. How much profit you are interested? How much profit you are going to be saved to make that desired units? Maybe your company is interested to make $5 million of profit. So this is the desired profit. So if the desired profit is previously set, then what will be the amount of units or numbers of units that need to be calculated? What is the formula of that? You see over here, fixed cost plus desired profit or expected profit divided by contribution margin per unit. Contribution margin per unit. So the fixed cost is given, desired profit also be given, and CM per unit. This is to be calculated like this. Contribution per unit, the same formula. That's why I am not showing over here the contribution margin per unit, but the same formula is to be used. Contribution margin per unit means selling price per unit minus variable cost per unit, which is given over here. So that formula is to be used over here. The fixed cost plus desired profit divided by contribution margin per unit. The figure you got, that is called the break-even points of expected profit. That is to be find out. Maybe it's the units, maybe it's the 500,000 units or 600,000 units, like that. And again, it is number 4. Break-even point, desired profit. It is volume. Volume means amount of sales. How much amount of sales you have to be required to get that particular amount of profit. So this is the break-even point. Is in bracket the desired profit. It is volume. Desired profit in volume, if the dollars or pound or rupees, like this. So this is the volume. So what is the formula of that? Fixed cost plus desired profit. It means the expected profit. What the company is expected. Maybe previously I am saying that $500,000 you are interested to make the profit. So this is the fixed cost plus desired profit divided by contribution margin ratio. Contribution margin ratio means selling price per unit minus variable cost per unit divided by selling price per unit. Then you got the contribution margin ratio. So fixed cost plus desired profit divided by contribution margin ratio. The figure you got, that is the volume or the amount of sales. Maybe it is the dollars or pound or rupees like this. Now number 5, margin of safety. It is very important for any organization. Margin of safety. Margin of safety means this is the difference between the actual sales and the break-even sales. Maybe the break-even sales you have already calculated, but actual can sometimes like this. Your organization is popular enough. Your company is getting popular day by day. As a result, demands is to be increased in the market. So more demand and it is met by the organization. So more sales is done. So this is means break-even sales, but break-even, what the amount of break-even sales, but the demands for the market or actual sales for the market is higher figure. Maybe you are interested to sell, the break-even point is the 500,000, but you have already sold in the market that particular year 600,000. So here the 600,000, then actual sales, break-even sales is 500,000. The difference figure is the margin of safety. Over here you see what is the formula of that margin of safety. It is the actual sales in unit. Maybe it is actual sales in 600,000. I have said earlier, and break-even sales in unit. Break-even sales in unit is the 500,000. So the difference figure is the margin of safety. So you have to require what is the margin of safety. So that is to be calculated by this here, actual sales in unit minus break-even sales in unit. Now the margin of safety of volume. Volume means the amount, how much amount you are going to be sold. So this is the margin of safety. Here the actual revenue or actual sales minus break-even revenue or break-even sales. Sometimes break-even sales is not given or the pound is not given. It is the another formula to calculate the break-even sales. Maybe the break-even points once you got that to be multiplied by the selling price per unit. Then you got the break-even sales. If the break-even sales is not given in volume, then you have to calculate the break-even points in units and that units multiplied by selling price. The figure you got the break-even sales. So here the actual revenue, actual sales the same thing, and the break-even revenue or break-even sales. So the difference figure is the margin of safety. That's all the 6 formulas. Hardly these 6 formulas is to be used for break-even point. So this is the presentation which the mathematically you have to calculate the break-even point analysis. Another thing is that graphical representation. Most of the cases you have to get in the question paper, you are instructed to do the break-even points in units mathematically as well as graphically. So graphically, whenever the break-even point is to be shown graphically, that is called the break-even point chart, which is shown in the board. Please, you are requested to watch it, to see it in the board. Over here, some of the graphical representation. This is the break-even point chart. Break-even point chart means the graphical representation of break-even point. Here you see the left-hand side. You to write the revenue or cost. It must be the dollars, pound or rupees like this. Left hand side you have to post over here. Left hand side the dollars or pound of sales or the revenue break-even point, whatever it is. It is the dollar or the pound or rupees in left hand side. In right hand side, production units. How much production? How many units you are going to be produced or going to be sold? That is to be shown in the bottom of the line. This is the production units. Here the cost or revenue and here the production units. So first of all, from the information you have to get the fixed cost. What was the fixed cost for the production or the organization? The fixed cost, the cost which not to be changed in a particular period. Maybe the one financial year, that is 12 months period, that cost cannot be changed. The two cost is over here. One is the fixed cost and another is the variable cost. Variable cost, the cost which normally vary according to the production. If you produce more goods, more variable cost is to be required. if you are going to produce less amount of goods, then you have to require the less amount of variable cost. So it is vary according to the production. So you see, first of all you have to plot the fixed cost. Here some of the line is over here, the straight line, the horizontal line is over here. This line is the fixed cost. It's maybe the cost is the $500,000, like this fixed cost. Now you have to find the variable cost. If the variable cost is given, that goods, so that is to be plotted over here. If variable cost is not given, then you have to calculate the variable cost. Variable cost means total unit multiplied by variable cost per unit. Then you got the variable cost, and that is to be shown in the graph. The variable cost is normally start with the fixed cost line. Here the fixed cost line is that, and variable cost like this. This line is the variable cost. This is the VC for variable cost, that is plotted. So here the fixed cost, and it is this space is the variable cost. This is space the fixed cost. So variable cost plus fixed cost altogether say the total cost. Here is TC for total cost, VC for variable cost, FC for fixed cost. Fixed cost plus variable cost is altogether say the total cost. That is written. This is the second bracket given. So altogether this space is said as total cost. Right now you have to find the selling price or total sales. So that figure may be given over here. You see here, this is start from the 0. So this line is going up. This is the revenue or sales. So that figure may be given or it is to be determined. So from the 0 point you have to draw. This is the hypothetically written or hypothetically drawing over here, but whenever you are going to do in the question paper or exam hall, you have to use the rulers, pencil or pen like this. So this is written. So from 0 point you have to draw the sales. Maybe the sales volume is altogether $15 million. Maybe the fixed cost is that $5 million. Variable cost is $10 million. 5 plus 10 is 15, and total sales also the $15 million. So the break-even point. So this line highlights the revenue or sales. So now you have to find the intersecting point of the total cost. Here the total cost line over here. This cost is the total cost. Here the point. This intersecting point is said the break-even point. Intersecting point over here, this is the break-even points. Maybe here the total production, maybe the 2000 units, and this is the break-even points. Here the sales, total sales figure is over here, $15 million. Out of $15 million, this is the $5 million fixed cost, and variable cost is $10 million. 10 plus 5, that is $15 million. The break-even points is that which make the zero contribution to the firm or the organization. This is the break-even point. Here this point is the break-even point. This point here, maybe the production is 2000 units. If the production is going to meet 2000 units, then the company can reach the break-even point. So now I have to discuss in respect of margin of safety. What is the margin of safety? Margin of safety is over here. Maybe the break-even points is 2000 units and actual sales is 3000 units. The difference between these two lines, difference between two, here is the 2000 units and the actual sales is 3000 units. So 3000 units minus 2000 units is the margin of safety. That is the profit for the business. Through the break-even points, we can find the three elements. One of the elements is that what the amount of sales in units or the volume that is to be determined. Second one, we can find the margin of safety. Margin of safety is what is the profit is generating by the business. That we can find over here, margin of safety. And another thing is that if the company is interested to have the expected profit, to have the expected profit. Maybe the company is the new one and they don't have the previous experience how to react in the market, or how the goods is to be sold, if the goods is to be becoming popular or not. Sometimes you are uncertain. So that's why from the beginning, as a beginners, you have to require some this knowledge, the what amount of sales we have to make, what will be the profit for the business. That also be ensured by the break-even point analysis. Another thing is that the margin of safety, what the amount we make, or our organization will have the margin of safety. So you see some of the spaces over here is the break-even point. So this space is the profit area. If the company can cross maybe the 2000 units is the break-even points. 2000 break-even points. If the company can produce 2100 units, then company start to make the profit. So this profit is to be started from this point. Here some of the angle is over here, this angle. So more spacious angle means more profit. Narrow spacious angle is said at the narrow profit or a small profit. So break-even point is that sense is very much important. Somebody is very much interested for the graphical representation. They can be known what amount, what the point we can have the break-even point. This is the break-even points. So the company must be reached this level. Otherwise, company could have lost. Maybe you are producing the 1900 units, but your break-even points is 2000 units. So you might have the loss. So you can be known from the beginning. If you are producing less unit of break-even points, you must have a loss. This is the loss area. This is the loss area. Loss area. And so less unit of 2000, then obviously you have to face the loss, and 2000 more units you have the profit. It starts to make profit. So that's why this is why for the management accountant, obviously it is very helpful for you if you get from the beginning, or the businessman from the beginning get the numbers of units going to be sold or the amount of sales that is to be made. They can do some of the initiatives or some of the action programs, so that level we can be reached. By doing this way, the business is getting the practical experience, empiric experience, which to be required for the next year or future years, which will be very much helpful for you. So break-even points is very important, no doubt. This is the management tools, and management tools frequently using this. So that's all for today. My next video on single entity system. You are requested to watch that, and if this video is helpful to you, obviously please make a like and share with your friend circles. So dear viewers, dear friends, that's all for today. Have a nice time. Goodbye.